This is Professor Hazara again, and this is the fifth in this first series of videos on international transactions. We're still dealing with traditional transactions. Um, the next two videos are the exact opposite of the last two videos I gave. In the last two videos, we had exposed net asset position, and we hedged it. In this video, also, we're just going to reverse the whole thing. The numbers will be similar, actually, um, but we're going to have uh, exposed net liability, which is a payable. So we have the other side of the transaction, and then we're going to have, then you're going to have, we're going to hedge it. Okay, so this is everything here is going to be the opposite of what we had there. Okay, so we'll start with a table. We'll put the date here, just including this thing. It'll be our debit and credit columns, and then we'll have this is in pounds again, pounds, and then we'll have a couple of rate columns. Okay, let's get started here. The easiest one. This is not doesn't not involve a hedge. Okay, so three transactions on November 5th, 2015. U.S. company purchases. So instead of selling something, we're going to buy. And what we're going to do is basically protect the cost or maintain the cost of inventory at the price we want it. Because if you have a payable that you owe and so you own a foreign currency and the dollars it takes to get that foreign currency go up because of the exchange rate, then the cost of your inventory effectively has gone up. Okay, so let's see what happens here. U.S. company purchased and receives 5,000 teapots from for 100,000 British pounds. The transaction is on credit, is denominated in pounds. Okay, at this date, each pound has a cost of $1.70. This is the direct exchange rate. Payment will be made 3 months later. So got a three-month forward contract. If we did the hedge here, we're not gonna do a hedge here. We'll do it next time. Then transaction 2, they close the books. The rate is $1.50. So they actually, in this case, when the rate goes down, they actually win because it costs less to obtain each pound that you're going to have to settle the contract with. Originally, it's going to cost you $1.70. Now it's going to cost you $1.50. So that would be a gain because it's costing you less. Then finally, you end up with a loss because the cost of each pound goes to $1.85. That's all that's happening here. Okay, so let's go ahead and we'll pretend they have a perpetual inventory system. Okay, so let's put this out a little bit. Okay, so date is, we'll do November 1, November 1, 2015. Okay, so we're going to debit inventory and credit accounts payable. And we're going to put an FC inside the payable because it is going to be denominated in foreign currency. Foreign currency is pounds. We will we'll get the rate there. We'll get that the sign in there in a second. And then each one's going to be worth $1.70, $1.70. So these are pounds. Let's get the currency right here. These are British pounds. I think they should. It's a major currency. I think they should put it up on top there. Okay, British pounds, and these are going to be dollars. Okay, so the inventory is initially going to have a cost in dollars of $170,000, and the this equals here. The accounts payable will be for 170, and you can kind of see the impact here. If this rate, your original dollar equivalent rate of 100,000 pounds is $170,000. If that rate goes up, your accounts payable is going to go up a lot more. It's going to cost you a lot more to obtain those pounds that you need. Okay, so then we come to December 1, 415. Yep, whatever format is good. Doesn't matter. So we come to that date right there, and this is when you just close your books. Now, this is a non-hedged transaction, so you're basically for better, well, you're exposed. That's the best way to put it. Okay, and at this date, each pound The original rate was $1.70. Now it's $1.50. Okay, so that means that we're going to have a debit to account payable FC, and we're going to have exchange gain here. You know it's an exchange gain just because you know it's going to be a credit, but it makes sense. It'll make sense. Okay, and so it's still 100,000 British pounds. The original rate was equal to $1.70. The new rate is equal to $1.50. Okay, but this means this is going to be equal to, you're going to have 100,000 British pounds. Each one is going to cost you 20 cents less, which is the difference between $1.70 minus $1.50. 20,000 equal 20,000. Okay, so I had an exchange gain there, and this gain I'm going to put here. The gain goes to the income statement. Okay, so you close that right to the income statement. That was the old way to do it. Okay, and then finally you settle this thing. Okay, and that's going to be on January 31, 2016. Okay, and the only thing that changes, well, you're going to settle it first of all, but the main thing that changes is that $1.85. So it's going to cost you a lot more. Just 30 days before, it would have cost you $1.50 to get each pound, and now it's going to cost you $1.85. Notice, by the way, that the accounts payable has a net balance of $150,000, which is 170 less 20, which is 150 for each one of those pounds. Now, however, we've gone up to $1.85. So the first thing you have to do is you're going to have to pay. There's going to be a debit to accounts payable. This way to do it, you're going to be writing off the accounts payable. So there's going to be a debit to the accounts payable. There's going to be a credit to cash, and this is foreign currency. Now you may have the foreign currency on hand, or you may have to go to an exchange broker to get it. It really doesn't matter. The reason is if you have it on hand, it would cost you more anyway. It costs you more whether you have it on hand, because it would be giving up something of greater value than it's worth 30 days ago, or it would just cost you more to go to the bank and buy. So either way, you lose. Okay, and so this is going to be a rather massive exchange loss. Okay, and the accounts payable. I'm going to put this here, but you just look at the balance. This is that, and the rate that the accounts payable is expressed as $1.50. That's the last one you adjusted for this transaction here. Another way to look at this is just take 170 minus 50. So you're writing off accounts payable 150, which gives you a balance of 0. The cash you're going to be giving up is 100,000 British pounds, and we know that each one, according to the circumstances of the problem there, is worth $1.85. Let's go ahead and change that. Okay, so the cash you're giving up is British pounds with a value of $185,000, and the difference between the two is your loss, which is $35,000. That's very easy to calculate. Also, it's 100,000, which times the difference between $1.85, which is what they cost you now. So each one costs you to get $1.85 less what they would have cost you as of the last adjustment, which is $1.50. Okay, so and I'll put that in parentheses here. I'll do this. That should tell you enough there. And so, since you did not hedge, you had nothing to offset. You had no forward contract to offset this exchange gain. More importantly, that exchange loss. As a whole, you ended up losing $15,000, which is 35 less that 20 right there. Okay, I'll put this video up, and then of course we're going to do hedge of this liability. It's virtually the same as last time, except it's going to be in reverse. Okay, so I'll put this one over here.